Most people who want to invest in property never buy a single investment property. Not because they lack the money, not because the market is too difficult, and not because the timing is wrong. They fail to start because no one ever handed them a clear, step-by-step process to follow. Today, I am handing you that process. Welcome to Property Investor TV. If you are serious about building long-term wealth through property, whether you are looking at the UK, continental Europe, or the United States, this channel is built specifically for you. We cover strategy, finance, deal analysis, and portfolio building with real numbers and real frameworks, not motivational generalities. In this video, you are going to get a complete roadmap for completing your first investment property purchase in 2026. We will cover how to define the right strategy for your specific situation, how to build the professional team you cannot afford to skip, how to assess a deal using the metrics that actually matter, and how to avoid the 5 mistakes that derail most first-time investors before they ever get to completion. Stay until the end, because in the final section I am going to walk you through the most expensive errors beginners make, and at least 2 of them are almost certainly on your blind spot right now. Defining your investment strategy before you look at a single property. B-roll note, overhead shot of a desk with a notepad, laptop showing a spreadsheet, and a cup of coffee. Calm. Professional workspace setting. The single most important thing you can do before looking at any property is define your strategy. This sounds obvious, but the majority of first-time investors skip this step entirely and instead jump straight into browsing portals and attending property events. That approach leads to confusion, wasted time, and in the worst cases, the wrong purchase. Your strategy must be built around 3 personal variables: your capital position, your risk tolerance, and your time availability. Your capital position determines your entry point. In the UK in 2026, a standard buy-to-let mortgage typically requires a minimum deposit of 25%, though some lenders will accept 20% on lower loan-to-value tiers. On a £200,000 property, that means a minimum of £40,000 to £50,000 in deposit capital before you account for stamp duty, legal fees, and a contingency reserve. In the United States, investment property loans generally require between 20% and 25% down. In markets like Germany, Portugal, and Spain, you are typically looking at 30% to 40% deposits as a foreign buyer, which changes the entry arithmetic considerably. Your risk tolerance determines whether you are looking at a vanilla single-let residential property, a higher-yielding house in multiple occupation, also known as an HMO, or a commercial to residential conversion. Single-let residential is the appropriate starting point for the vast majority of beginners. It is lower yield but also lower management complexity and lower regulatory exposure. If someone is trying to sell you an HMO or a serviced accommodation deal as your first investment, be skeptical. Your time availability determines whether active or passive income is the right model for you. A self-managed single-let in your local area can generate strong net returns but demands your time. A professionally managed property in a different city or country is closer to passive but comes with a management fee, typically 8% to 12% of gross rent in the UK, and requires you to trust your letting agent completely. Once you have answered those 3 questions honestly, you have the foundation of a strategy. Write it down. A sentence is enough. I am targeting a single-let residential property in the north of England, priced between £120,000 and £180,000, managed by a local agent, aiming for a gross yield of at least 6.5%. That clarity will save you months. Building your power team. B-roll note, wide shot of a professional meeting in a bright office, 4 people around a table reviewing documents, with natural light and a city backdrop. Property investment is not a solo sport. The investors who move quickly and confidently do so because they have built a reliable team before they need it. Building the team after you find a deal is the amateur approach. By the time you have instructed solicitors you have never used before, found a mortgage broker mid-offer, and tried to assess a refurbishment cost without a trusted tradesperson, you have lost time, and quite possibly the deal itself. Your core team for a first investment property consists of 5 roles: a specialist mortgage broker, a property solicitor or conveyancer, a letting agent, a local building surveyor, and a trusted contractor or trades contact for refurbishment assessment. The mortgage broker is arguably the most important appointment. In 2026, the buy-to-let lending environment remains complex. Lenders are stress testing rental income at rates significantly above the product rate, typically at 125% to 145% of the monthly mortgage payment at a stressed rate of around 5.5% to 6%, depending on the lender and your tax position. This means a property that cash flows positively for one borrower may not meet affordability criteria for another. A broker who specializes in investment property will know which lenders suit your profile, your entity structure, whether personal name or limited company, and which product fee structures make sense at different loan sizes. Your solicitor needs to be experienced in investment property conveyancing, not just residential sales. They should be comfortable with leasehold properties, title defects, and in the case of HMOs or commercial conversions, planning and permitted development queries. Your letting agent should be selected before you make an offer. Call 3 agents in your target area. Ask them for current achievable rental figures on the specific property type you are buying. Ask them what their current void rate is. Ask them who they use for maintenance and repairs. The answers will tell you a great deal about their quality, and the rental estimates they give you will feed directly into your deal analysis. Your building surveyor is your protection against hidden structural or mechanical problems. A full structural survey on a pre-1980 property is not optional. A £500 survey that reveals £18,000 of remedial work is money exceptionally well spent. Never skip the survey to save a fee. How to analyze a deal. The numbers that actually matter. B-roll note. Close-up of a spreadsheet on a laptop screen showing yield calculations, with a property listing printout beside it and a calculator in frame. There are 3 numbers every beginner investor must understand before assessing any deal: gross yield, net yield, and monthly cash flow. Together they tell you whether a property is worth pursuing or whether you should move on. Gross yield is the simplest starting point. Take the annual rental income, divide it by the purchase price, and multiply by 100. A property purchased for £150,000 generating £9,000 per year in rent has a gross yield of 6%. In the UK, a gross yield below 5% on a standard single let is difficult to make cash flow positive after costs at current mortgage rates. In higher yielding Northern English and Scottish cities, gross yields of 6% to 8.5% are achievable. In London, gross yields commonly fall between 3% and 4.5%, which is why most cash flow focused investors do not start in London. Net yield accounts for your actual costs. Subtract your mortgage interest, letting agent fees, insurance, maintenance provision, typically 10% to 15% of gross rent on older properties, void allowance, and in the UK, any ground rent or service charge on leasehold properties. What remains divided by your total capital invested gives you net yield. A property showing a 7% gross yield may deliver a net yield of 3.5% to 4.5% once those costs are properly accounted for. Monthly cash flow is the figure that keeps you in the game. It is the rent collected minus every monthly outgoing, mortgage payment, management fee, maintenance reserve, and insurance. If this number is negative, the property is costing you money every month. Some investors accept modest negative cash flow in exchange for strong capital appreciation potential, but for a first deal, positive monthly cash flow is strongly advisable. It reduces financial pressure, keeps your reserves intact, and gives you options. In the United States, the 1% rule is a commonly used heuristic. Monthly rent should equal at least 1% of the purchase price. On a $200,000 property, that implies $2,000 per month in gross rent. This rule is a quick filter, not a full analysis, and it tends to work best in Midwest and Southern markets rather than coastal cities. Run every deal through all 3 of these metrics before you make a decision. A deal that looks attractive on gross yield may look very different when you stress test the net cash flow at a 1-month void and a boiler replacement in year 1. The 5 mistakes that derail first-time investors. B-roll note. Slow motion footage of a person pausing at a crossroads, looking at a map. Metaphor for decision making at a critical juncture. You can do everything right in strategy, team building, and deal analysis, and still lose ground if you fall into any of these 5 mistakes. They are extraordinarily common, and at least some of them will feel familiar. Mistake number 1 is buying in an unfamiliar market without local intelligence. Gross yield figures for a postcode mean very little without understanding the tenant demand, the quality of local employment, the rental competition, and the neighborhood trajectory. A city with a 7% average yield that is experiencing sustained population decline is a worse investment than a city with a 5.5% yield and growing demand from a university or a major employer. Do the local research. Speak to letting agents on the ground. Visit the street. Mistake number 2 is underestimating total acquisition costs. Beyond the deposit and the purchase price, your first property purchase will involve stamp duty. In England, buy-to-let purchases attract an additional 3% surcharge above standard residential rates, plus legal fees, broker fees, survey costs, and an immediate refurbishment if the property needs work before it can be let. Budget a total acquisition cost that is 4% to 6% above the purchase price before you model any returns. Mistake number 3 is over-leveraging on the first deal. The temptation to maximize loan-to-value in order to preserve capital is understandable, but higher leverage means higher monthly payments, tighter cash flow margins, and less resilience when rates move or voids occur. On your first deal, conservative leverage is your friend. Leave yourself room to breathe. Mistake number 4 is confusing a strategy with a dream. Saying I want to invest in property is not a strategy. I want to buy a Parisian apartment is not a strategy. A strategy has a target geography, a property type, a price bracket, a financing model, and a return threshold. Without all 5, you are not investing, you are browsing. Mistake number 5 is waiting for perfect conditions. No market in 2026, or any year, offers perfect entry conditions. Rates are elevated compared to the historic lows of the 2010s, but real property returns have been generated in high-rate environments throughout history. The investors who waited for perfect conditions in 2019 missed 2020 and 2021. The investors who waited in 2022 missed 2023 and 2024. Taking a well-analyzed, conservative first step in an imperfect market is categorically better than taking no step at all. Let us bring this together with 3 key takeaways from everything we have covered today. Takeaway 1. Define your strategy before you look at any property. Your capital position, risk tolerance, and time availability are the inputs. Your target geography, property type, price bracket, financing model, and return threshold are the outputs. Write it down and use it as a filter for every opportunity you encounter. Takeaway 2. Build your team before you need it. A specialist mortgage broker, a property solicitor, a vetted letting agent, a building surveyor, and a trusted contractor contact are not optional additions. They are the infrastructure that enables you to move with speed and confidence when the right deal appears. Takeaway 3. Run every deal through gross yield, net yield, and monthly cash flow before you make a decision. If the cash flow turns negative under a mild stress test, 1 month void, 1 significant repair, the deal is telling you something important. Listen to it. The roadmap exists. The numbers are knowable. The team is buildable. Your first deal in 2026 is genuinely achievable if you follow a structured process and resist the impulse to skip the foundational steps. If this video has given you clarity on where to start, do 2 things right now. First, subscribe to Property Investor TV so you never miss a new framework, market analysis, or deal breakdown. Second, download our free deal analysis checklist linked in the description below. It covers every metric we discussed today in a single, ready-to-use document you can apply to any property in any market. Drop a comment below telling me which stage of this roadmap you are currently at. Strategy, team building, or active deal search. I read every comment and your answer will directly shape the content we produce next. And if you know someone who has been talking about investing in property for the past year without taking action, share this video with them today. It may be exactly what they need.